Welcome to this week's episode of Jonathan on Money. This is episode number 150. So this episode's going to drop right after the holiday of Purim, and I catered my talking points to that theme. In terms of what else is going on in my life, not too much, but I could sum it up as follows. I'm pretty fed up with the snow, like totally burnt out from it. For those who don't live in the New York City area, we've had another major snowfall the other week, and we've had several this year. And I never thought I would be eagerly welcoming rain to wash away the snow, but that is my current mindset. Florida is increasingly looking better from a taxes perspective, lifestyle, and of course the weather. In other news, here's a reminder about my new book, D's for Diversification, the ABCs of Personal Finance, which is now available on Amazon or at jonathanonmoney.com. And finally, before we jump into this week's episode, I'd like to share that my upcoming live winter webinar will be on Thursday, March 12th at 8:30 a.m. featuring Kevin Matz, who's a partner at Aaron Fox Schiff LLP based in New York City. And Kevin's going to be discussing highlights of the 2026 Heckerling Institute on Estate Planning, and I'll be sure to include the registration information in the show notes to this episode. And now for today's agenda. My talking points this week will discuss five hidden investing lessons from the Megillah. Our quote this week is from Isaac Newton on calculating the motions of the heavenly bodies. I'll spend the last half of the episode answering listener questions, including mitigating the owner's tax liability in an irrevocable trust. And finally, we'll end with an actionable idea to implement to your investing life. We're going to discuss how to simplify your finances. With that, let's jump into this week's talking points. So, on the theme of Purim that took place a day before this podcast dropped, I'd like to share five hidden investing lessons from the Megillah. And for those who don't know, Purim is a joyful holiday celebrated with costumes, humor, and festive meals. Yet, underlying the revelry is a story about hidden risk, sudden reversals, courage under pressure, and long term survival. These themes, central to the Megillah, also map surprisingly well onto the world of investing. The narrative of Esther and Mordecai offers a framework for thinking about uncertainty, preparation, humility, and responsibility. When viewed through the lens of financial decision making, Purim becomes more than a historical drama. It becomes a guide for navigating markets that are unpredictable, emotional, and often shaped by forces we cannot see. So, lesson number one is that hidden risk matters. In the Megillah, the danger facing the Jewish people is not immediately obvious. It develops quietly through palace politics, personal grievances, and the manipulation of power. In fact, while the Megillah only takes 30 to 40 minutes to read, hopefully a bit less, the actual story unfolded over nearly 10 years. By the time the threat becomes clear, the decree has already been sealed. Markets operate in a similar way. The most dangerous risks are rarely the ones that dominate headlines. They're the ones investors ignore during good times because everything appears stable. Concentration risk, excessive leverage, the lack of liquidity, and overconfidence in one's investing ability tend to build slowly. They accumulate beneath the surface during a bull market as investors grow complacent. When these risks finally reveal themselves, prices adjust long before most investors have time to react. Purim reminds us that danger often hides in plain sight and that vigilance is essential even when everything appears calm. Lesson number two is that reversals of fortune happen quickly. Haman seems unstoppable for much of the story. He has political power, he has the royal favor, and a plan that appears airtight. Yet, in a matter of hours, the narrative flips. The villain is exposed, the decree is challenged, and the Jewish people are saved. Markets behave with similar speed. Bull markets feel permanent while they last, and downturns feel endless when they arrive. Both impressions are illusions. Sentiment can shift in a single week. Economic data can surprise. Geopolitical events can reshape expectations. A prime example is the COVID-19 pandemic, when the markets dropped over 30% in a matter of weeks and then bounced back equally quickly. An individual stock may feel rock solid, but then airplanes start falling out of the sky, and Boeing's dividend was cut to zero, and the price dropped by 50%. Investors who rely on trying to predict the next twist often find themselves reacting emotionally rather than strategically. Purim teaches that dramatic reversals are part of life. A disciplined asset allocation grounded in long term thinking rather than short term forecasting is often the wiser path. Lesson number three is that preparation does matter. Mordecai tells Esther that perhaps she attained royalty for precisely the moment when her would be needed. Her preparation, her character, her willingness to act created the possibility of salvation. In investing, preparation creates optionality. Liquidity, diversification, and patience allow an investor to act decisively when opportunity appears. You cannot control market events. However, you can control how prepared you are when they unfold. Investors who maintain a cash reserve, avoid excess leverage, have proper insurance, and build portfolios that can withstand volatility or adverse events are better positioned to take advantage of most market dislocations and challenging life events. Preparation is not glamorous, but it's powerful. An Esther's readiness changed history. An investor's readiness can change financial outcomes. Lesson number four is that luck and skill are not the same. The very name Purim comes from the word pur, meaning lots. The story acknowledges the role of chance in human affairs. Haman cast lots to determine the date of destruction, and the entire narrative hinges on a series of seemingly random events. Markets can contain randomness as well. A strong year does not prove genius, and a weak year does not prove incompetence. Investors often attribute success to skill and failure to bad luck, but the truth is more complicated. A sound investment process matters far more than any single outcome. That's something I harp on all the time. Evaluating decisions based solely on results can lead to overconfidence during good times and unwarranted despair during bad times. Pearl reminds us that chance plays a role in every story. The goal is not to eliminate randomness, but to build a process that can withstand it. And finally, lesson number five is that community and generosity are central to a meaningful financial life. Purim emphasizes Mishloach Manot and Matanot Levyonim, acts of giving that strengthen communal bonds and support those in need. Similarly, financial success detached from values can become hollow. Wealth is a tool, not an identity. It's meant to support family, communal responsibility, and the ability to contribute to something larger than oneself. Investing is not only about compounding returns, it's also about compounding impact. Herm's emphasis on generosity reminds us that money gains purpose only when it is used to uplift others. And here's a final message for investors. The Megillah is a story shaped by uncertainty, hidden danger, and redemption that arrives through courage, clarity, and preparation. Successful investing echoes these same themes. Build a portfolio and a life that can absorb surprises without losing direction. Focus on decisions you can control. Accept that uncertainty is part of every financial journey. Remember that resilience, generosity, and thoughtful preparation will always serve you better than trying to predict the next dramatic turn in the story. Okay, those are the talking points this week. And as a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Isaac Newton. For those who don't know, Sir Isaac Newton was an English mathematician, physicist, and astronomer whose discoveries reshaped modern science. He was born in 1642 in Wiltshire, England. He became the central figure in the scientific revolution. And Newton formulated the three laws of motion and the law of universal gravitation, creating the foundation of classical physics. His work in optics demonstrated that white light is composed of different colors, transforming the study of light. He also developed calculus, providing a new mathematical language for change and motion. Newton's landmark book, Philosophia Naturalis Principia Mathematica, in 1687 unified physics under a single framework and remains one of the most influential scientific works ever written. And Newton once said, I can calculate the motion of heavenly bodies, but cannot calculate the madness of people. He is reportedly to have said this after losing a fortune in the 1720 South Sea bubble, where he lost most of his money. The quote emphasizes that while physical phenomena like the motion of planets follow consistent, logical rules, human behavior, on the other hand, and emotions and greed are unpredictable and often defy logic. It serves as a humbling reflection on the limits of human intellect when confronted with collective madness or irrationality. The end of the day, investing is probably 20% intellectual and 80% psychological. If you can keep your emotions in check, you'll be ahead of most people, especially the ones with super high IQs who try to boil everything down to equation, which can't be done in the world of investing and personal finance. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me and it may be answered in a future episode. Okay, first question. I have only 200K saved for retirement, and I'm 67 years old. I make a healthy living, have no debt, and I'm finally in a position to save money. My advisor said I should save 50% of my net income for the next 7 years, and I should be able to retire comfortably. My thought is that I can die or become disabled in a few years. Why not enjoy my money while I can? Looking to get your honest opinion on how to proceed. So, alternatively, you can live another 30 years, and if you don't take your advisor's advice and live large for the next few years instead of saving, you could be destitute and need to rely on family and charity to support you. Not an optimal situation. Keep in mind, planning to drop dead sooner rather than later is not a sensible financial planning strategy. If you don't want to work for 7 years or save as much, then move to a kibbutz in Israel where you may be able to stretch out a more modest amount of savings for longer with socialized medicine, extremely modest living arrangements, and no expensive hobbies or lifestyle decisions. Based on the phraseology of your question, it seems like you want to blow your funds relatively quickly and live the good life. The problem is you're basically broke. Yes, 200K net worth at 67 while living in the US qualifies as being basically broke. You need to make some tough decisions, get in tune with reality, and then you can make the most of the money you have when you ultimately retire, which probably won't be anytime soon. Next question. Back in the day, going to a movie was a good activity for the whole family. A few bucks and you can see a movie and get popcorn and a drink. The other day, I just spent $200 for a film and popcorn and a water and or waters for the whole family. Is this a good ROI? So if your family had a good time and you could afford that financial outlay, then it was a good return on investment or ROI. I hear your frustration with the movies today. It's expensive and the fancy chairs that you can adjust is a huge problem when you have a kid next to you with a deadbeat parent or guardian who doesn't reprimand their kid for spending the entire movie adjusting the chair. It's mama's awful. I have a personal experience with that. Anyway, I think you need to reconsider your perspective when ascertaining if this type of activity is worthwhile. Sure, you can watch Netflix at home with a snack on your couch for far less money, but going to a movie theater is about the experience. If you're paying a buttload of money for that experience, you are paying a buttload of money, I should say. Similarly, when you go to a professional sports game and they have a kosher hot dog for $12 that are of mediocre quality, you shouldn't complain about the price or and the taste. I mean, you can complain about it and probably should since it's your God to give a right as a Jew. You're paying for the experience of being at the ball game with a bad overpriced hot dog and a crappy beverage. That experience, like going to the cinema with the mishpacha, should spark joy in your life. If it doesn't spark joy, then it is not a good ROI. If it does spark joy, then your financial outlay is immaterial, assuming you can afford it. Just enjoy and savor that experience. Next question. My assets are in an irrevocable trust. As you know, the tax rate on trust is more aggressive than on money held personally. Is there any way to mitigate this tax liability? Yes, there are strategies to help mitigate the trust tax liability, but first, for those who don't know, irrevocable trusts, specifically non-grantor trusts, are subject to compressed federal income tax brackets, meaning they hit the highest tax rates at a much lower income threshold than individuals. So, at only $15,200 of income, the trust is taxed at a 37% rate. Wow. One thing you could do is distribute some income to beneficiaries. You should work with your CPA and financial advisor to ensure that income generated is distributed to beneficiaries, especially those in a lower bracket, in order to avoid generating a large tax burden. Other considerations that may or may not be relevant, depending on the trust structure, include investing in tax efficient investments, which may require the trade off higher growth or better risk management within a portfolio, or using multiple trusts to mitigate the tax burden. Naturally, this is a topic that should be discussed with a competent trust and estates attorney and knowledgeable CPA. Speaking from my experience, not every CPA or attorney is familiar with this topic, and you need to seek out professional professionals with this specific knowledge. Most financial advisors have zero clue about this topic. So if you do have irrevocable trust as part of your planning, finding a competent advisor slash money manager can work with your attorney and CPA is an imperative thing to do. Do you ever turn away potential clients that have a lot of money, say eight figures and higher? Yes, every year. I've met with family offices, hedge fund executives, and entrepreneurs who sometimes have net worths that are nine or 10 figures. And after a series of discussions, I decide not to pursue working with them. Working with someone is difficult, who is difficult, unpleasant, or doesn't buy into my philosophy is not worth it for me. It will lead to stress, headaches, and frustration for everybody. There was a point in my career about 15 years ago where I would take any client with a post and a few dollars to their name. I am long past that point. I work with people who I like, buy into my philosophy, and have a reasonable amount of money to manage. I am not super motivated to get more assets under management and generate more revenue if it means more stress. I don't work at a large bureaucratic institution with sales contests or the risk of them cutting my compensation if I'm not generating a certain amount of revenue every year. Therefore, I am not motivated to take on difficult people who sell expensive products to increase my revenue. I know this philosophy may seem foreign to some people, especially living an Orthodox lifestyle, which is quite expensive, but that's where I'm at today. Over the years, I've streamlined my client base to focus more on working with people that fit my desired criteria and not pursue opportunities that don't fall within my parameters. My life has certainly improved because of it, i.e., my blood pressure has gone down, which is a real life measure of success. Next question. What is the difference between good debt and bad debt, and specifically how to create a formula to determine when it makes sense to pay off a large debt like a mortgage or a student loan if you come into a lot of cash through an inheritance or business sale? If it's 9%, of course you pay it down. If it's 3%, of course you keep it and invest the cash. But what is the formula to find the exact number that makes sense for you in between those extremes? So I wish I could boil down to a simple formula, but much of the decision may depend on context. Like you said, very high interest should be paid down immediately, and low interest rate on good debt, like a mortgage on your primary residence, you may not want to rush to pay down. However, something like student debt depends on a variety of factors. Let's say your family has no money, but you got into Wharton and want to pursue a career in investment banking, or you got into Harvard Law School before it became a breeding ground for anti-Semites, and now you will pursue a career in corporate law at a major law firm. Well, in those situations, taking out debt to make this opportunity come to fruition seems sensible because you will earn enough money to pay down your entire burden within a few years. This is a different scenario that your question. I'm just illustrating how debt in this situation may be a good thing. The same thing may apply for a business loan. If you have experienced a sensible business plan and need to take out a reasonable business loan to start your business, then that may be prudent, and rushing to pay it down may not make business sense since it's better to reinvest in your growing business. On the other hand, you may have multiple outstanding debt that have 7 to 8% rates of interest, but paying those debts down may mean putting our life and business decision on hold, like having more children, buying a more comfortable home, investing more in the market to be able to retire sooner, etc. This is a long way of saying that I think paying down certain debts requires a conversation with a financial advisor to weigh the pros and cons of the decision. Not every decision in finance or life in general is black and white. Sometimes you just need to think things through, hear well informed opinions, and then make the best decision you can with the information you have. I think anyone that tries to boil down the answer to a rule of thumb is not being realistic. And I'm sorry this answer may not be satisfying, but hopefully you'll get over it. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me via email. Perhaps my team and I can help you. Best way to get a hold of me is Jonathan at ParkBridgeWealth.com. And finally, I'd like to end with a timely and actual idea that listeners can implement to their financial lives. Today's timely idea is relevant to tax season, which is to simplify your financial life. This time of the year, if you find yourself gathering tons of 1099s to send to your CPA, here's a reminder to get your investments consolidated at one institution. Keeping your finances consolidated and organized is always sensible. This is even more important as people age. As a youngster, you may be able to more seamlessly track a multitude of accounts at various brokerage firms. This will become increasingly more cumbersome and stressful as you get older. I suggest to all my clients, especially those approaching retirement, to consolidate their accounts wherever possible. This includes rolling over old 401ks, consolidating various IRAs and taxable accounts where appropriate, and managing all banking, i.e., checking, at one institution. Furthermore, having a seamless process for a child or trusted family member to make decisions on your accounts in case you no longer have capacity will save a lot of heartache and frustration later. If I can help with this organization, feel free to reach out to me directly via email. With that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.